great. Thank you, Kimberly. Good morning. Good afternoon, actually, everyone. It's now just afternoon. We appreciate you joining us today. Today's meeting is a follow-up from our presentation a few weeks ago. We were fortunate enough to have Clifton Larson and Associates, a prominent, actually regional, semi-national CPA firm, join us and give us a lot of insight into what is potentially going on with tax law changes, as well as some absolute certainties in terms of changes and things that we should expect. Today is a follow-up meeting. I'm joined today by Christina Strickland, an advisor on our team, Ray Evans, and Jim Stanziola, also advisors on our team. Jim also serves a unique role. Jim and I have worked together for 30 years as financial advisors together, but he also holds his law licenses Kansas, Missouri, and has done a lot of estate planning for clients of the firm and outside clients. So I'll begin by introducing today Christina. Christina will talk a little bit about some of the specific, and again, everything today is about some of the specific things that you can be doing right now, either year end or planning that you can be doing for next year to put yourself in the best position to reduce taxes, to maximize the wealth to your family. Again, today's presentation will focus on both things that individuals can do, and there'll be quite a bit of material that is directed at small businesses as well. So sometimes, perhaps you're not running a small business, but you've got a family member that is, and so it might be important to take some notes and pass some of these ideas on to someone else close to you. So with that in mind, Christina, I'll let you take it away and talk a little bit about the first slide or so, and then transition back to me.
Perfect. Thanks, Tim. So as Kimberly is pulling up this first slide for us, you'll see these numbers on the screen. Don't worry, I'm not going to go line by line for you, so you don't have to listen to that, but please feel free to have a look at those, find a plan that you may or may not be impacted by, such as a 401k or a 403b, and kind of talk for a moment about closing out 2021. So obviously it would be a very good opportunity for you to make sure that you're on pace to max out any retirement plan contributions for the year. Some of the folks on the call who are still working might have 1 or 2 pay periods left through this year. So make sure you're going to be on pace to max out those contributions if you're eligible for that. Make sure while you're in your workplace retirement plan and you are making sure you're on pace to max out those contributions, while you're in there, go ahead and take this opportunity to double check your investments, make sure you're comfortable with the risk tolerance that you're at. Also, go ahead and double check your beneficiaries while you're in there as well. I'm a really big fan of any time you're looking at any of your investments, you may have only initiated that look, if you will, to check on one thing. In this case, you might be only intending to check on your contributions. But since you're in there, go ahead and kind of look at everything, make sure investments and beneficiaries are good as well. In addition to your workplace retirement plan, if you are on track to fully take advantage of all of the contribution opportunities there may be other accounts that you might have availability to save in additional ways that can help reduce your tax liability. You might have access to an HSA plan through your employer. You might have a 529 plan. Maybe you've got kids, grandchildren, nieces or nephews, someone that you can kind of help defer some of your taxable income by helping out a family member in that regard. Double check and make sure if you are eligible to max out a Roth that you're going to do that. If you're eligible to make tax deductible IRA contributions in addition to your workplace retirement plan, make sure that you have a plan to do that if you'd like to. And then another thing that I hear people talk about a lot when we kind of go over end of the year planning is that it is possible, if you are not eligible to make a deductible IRA contribution, you could still put some assets in an IRA and simply not deduct them from your taxes, which again doesn't help reduce your taxable income, but it does give you another bucket of tax deferred growth, which may be advantageous to you in the future. So for closing out the year, just double check all of your workplace retirement plans or any sort of retirement accounts, college savings, your health accounts. Make sure you're on track to maximize those. And then make sure moving into next year, you have a plan to maximize those contributions. You will see on the screen that 401ks and 403bs, as well as 457s, did receive a $1,000 bump in maximum contributions. So in 2021, the limit was $19,500 for individuals under the age of 50. For next year, if you're under the age of 50, you'll see an additional $1,000 that you're allowed to contribute, now up to $20,500. The catch-up did remain the same at $6,500. So if I'm over the age of 50, I am allowed to contribute up to $27,000 next year in my 401k, 403b, or 457. Simple plans did get a $500 increase on that simple 401k. We moved up from $13,500 in 2021 to $14,000 in 2022. Also, the highly compensated employee threshold changed. So if you have been previously considered a highly compensated employee because you made over 130, for 2020, that limit has been increased to 135,000. And so that's important, because if you have previously been considered a highly compensated employee, and if that has limited how much you've been able to contribute to your workplace retirement plan, double check and see if that rule still applies for you for 2022. There's every year, quite a few people I work with on the 401k side have been making contributions based on the assumption that they're a highly compensated employee, but that limit increases every year as well. So just double check, make sure that if you're impacted by that, you're in line with how much you're contributing to your plan. In addition to that, something to consider for 2022, and I want to make sure that everyone really understands how their workplace retirement plan works, because this is a question I get asked multiple times a year. It's important to understand how your employer matches your plan. And what I mean by that is some employers, match on a per payroll basis. Some employers do it at the end of the year in what's called a lump sum match. If your employer does it on a per payroll basis, the reason that's important to you is because I work with a lot of participants in 401k plans that intend to simply contribute as much as they possibly can to hit that $20,500 max as soon as possible, so that the rest of the year they know they've already saved as much as they need to in their workplace retirement plan, and they're not worried about it anymore. The problem with that is, hypothetically speaking, if I hit my max in June and my employer matches each payroll period, and if I don't need to make any more contributions because I've already hit my max, then I may very well be missing out on matching dollars for the second half of the year. And so make sure you understand and work with your human resources or with your advisor on your plan. Hopefully that's us, but make sure you understand how that works so that you can really make sure you're taking full utilization of that matching formula that your employer provides. Again, that's something that we see all the time, and I would just hate for anyone to miss out on any possible matching dollars that they might get. So 2021, make sure you're on track to max out. Make sure for next year you're on track, especially with that $1,000 increase. That will probably necessitate some some payroll contribution changes on your end. If you need help with the math on any of that, please feel free to reach out to our team. We'd be more than happy to help you with that. And with that, I will pass it over to Tim.
Oh, thanks for passing that back, Christina. That's a good summary. There's always a lot changing, and it really, what you're referencing in regards to that match formula is very important. How your 401k or your 403b plan is written, in terms of how that document is written. And so we're seeing a lot of changes in the retirement plan arena. So again, particularly if you have a family member that owns a business, runs a small business, a large business, or if you run one yourself, this next slide or two might be really important to be aware of. There is a brand new tax credit as of the Secure Act, which passed in 2019. COVID hit immediately after the Secure Act passed, and so there wasn't a lot of attention paid to some of the important tax law changes. One of which is that there's this tax credit of up to $5,000 worth of expenses is available for a company that is perhaps been thinking about starting a retirement plan, whether that be a simple IRA, a SEP IRA, or maybe they've decided it's time to have a 401k at their company. So this is a great opportunity. And again, not a deduction. Normally expenses are deductible to a company like this, but this is literally a tax credit. Last time I checked, there are 18 states that are now requiring some form of retirement plan for the companies that operate in their state. So that is a trend that is picking up steam. I would not be surprised at all within the next decade if you don't see in all 50 states some form of a requirement to have a retirement plan. So that in mind, if you've been on the edge of perhaps doing this, now would be a fantastic time to start a retirement plan for your employees. And that is, so long as you have 2 or more employees, it's companies with as many as 20 employees. You can see the formula on your screen there. It's actually kind of complicated, but I would tell you that if you have 20 employers or more that are working full time, then you're going to be able to probably get to the full $5,000 tax credit in terms of getting those expenses covered. So that's a great incentive. Additionally, one of the big trends that's going on within the retirement plan industry is the move from most plans to include some form of auto enrollment into the equation. In fact, many of the states that have these required retirement plans are using auto enrollment. So if you do auto enrollment, you get an additional $500 tax credit. On this next slide, I just want to hit for a minute or two on some trends that Christine and I are on the retirement plan team. We see, we work with employers almost every day, and there has been a lot of movement in terms of the way that companies are designing their retirement plan. As I mentioned, a huge trend within the country is adding the auto enrollment and the auto escalation to the retirement plan. This is having a huge impact in increasing savings rates for employees. It's really a cultural change, a behavioral change that's having a great positive effect. At the same time, we are quite aware that the stock market is doing really well. And part of the reason, one of the key attributes for the stock market doing well is the amount of liquidity in the marketplace. Interest rates are low. There's more cash on the balance sheets of companies and individuals in the United States than there ever has been in the history of the United States. And so because of that liquidity, beyond the stock market doing well, what we're seeing is companies that are deciding to make changes in the way they fund their retirement plan. They're looking for ways to increase the amount of contributions to participants, but they're also looking to find ways to increase the contributions to the owners of the business and the highly compensated employees that Christina was mentioning. There have been restrictions in the past. Many companies struggle with difficulties in getting enough money and even a proportionate amount of money percentage-wise to their highly compensated employees. So this changing from the old traditional safe harbor match formula, we're seeing a lot of companies move to a 3% across the board contribution to their employees in a same safe harbor formula. What this allows them to do, and if your company is looking at a good year, if you're profitable and you're looking to shelter some additional income, they're adding a cross-tested provision or a cash balance provision. And what this does, by moving to the 3% non-elective automatic contribution, you can then automatically put in 6% more, and you can discriminate just for the highly compensated or just for the owners. And you even have the ability to discriminate between which highly compensated and ownership employees you want to give that to. So you've got a lot of control as a business owner in terms of changing your retirement plan and perhaps redefining something that might increase the benefits to everybody within the company. So we wanted to highlight that. We're seeing a lot of companies make this change. I'm actually, as you probably can see, I'm mobile this afternoon. I just got done meeting this afternoon with a company down in South Kansas. They actually just changed the design of their retirement plan. And they're also, like many companies, having a very hard time getting the employees they need to satisfy the demands of their customers. One of the things they're considering, in addition to changing their plan, is adding a deferred compensation plan to their normal retirement plan. This deferred compensation plan allows them to select specific employees. In this case, they're in the construction industry. It's very difficult for them to find experienced field superintendents who take responsibility for these jobs on site. Every business has a set of employees that's critical to the business. Deferred compensation plans allow you to give a specific contribution to the individuals you choose, and allow them some tax benefits. And then there's some long-term tax benefits to the company as well. So I know I've talked broadly about several changes that you could be making, and I know that this applies to business owners almost exclusively, but make notes. If there's someone who can help you, please reach out to Christina or myself. We'd be glad on a complimentary basis to share with you some things that you might be able to do, whether that be, could be a son or a daughter who's starting a business and wants to consider a retirement plan, or maybe you have one now and you want to make a change. So with that in mind, I'll introduce Ray Evans. Ray is also one of the senior partners in our firm. We've got a lot of clients who are, again, looking to reduce taxes and find ways to do that. And so, Ray, you mind sharing us the next slide with us?
You bet. Thanks, Tim, and thanks, Christina. And want to reiterate what a tremendous asset their team is to the rest of us here at Infinitas. They know all of the ins and outs regarding changes in qualified retirement plan business, and really non-qualified for that matter. So thanks you guys very much. I'm going to pivot and maybe talk about two tactics to be thoughtful of, not necessarily by year end, but that also apply moving forward. And these come to individuals, and we're talking about from a charitable giving perspective. And the very first thing I'm going to talk about are qualified charitable deductions. Now, this is a tax-free distribution from a traditional IRA, your traditional IRA, that is sent directly from your IRA to the charitable organization. Now, there's a couple of rules that are involved. You have to be age 70 and a half or older to be able to do this. And a good thing for you, this distribution, if you're over 72, can be used to also meet minimum required distributions from IRAs. So again, you've got to be at least 70 and a half to be able to do this. And this doesn't quite apply to all retirement plans. Now, it applies to traditional IRAs, and also any IRAs you've inherited from a family member. Does not apply to SEP IRAs and simple IRAs, which are typically small business retirement plans. To do this correctly, it does, of course, require a decent amount of paperwork. And I want to emphasize the check has to be sent directly from your IRA custodian and made payable to the charity. Can't be made payable to an individual or any other entity. The cool thing is the limits are substantial. The current donation limit is $100,000 per person, and married taxpayers that are filing jointly can actually exclude up to $100,000 from each spouse's IRA. And again, I want to emphasize where we use this a lot and where we bring it to people's attention is this can be used to satisfy some or all of your RMD, required minimum distribution from your IRAs. So if a taxpayer is eligible to make a qualified distribution, and again, 70 and a half being the key issue, you can make a single payment for $100,000 to an entity, or you can actually, as most people actually do several of these either throughout the year or late in the year. I want to emphasize, and I'm chuckling as I know I have staff members that are listening, don't call us December 29th and want to get this done. It is difficult to actually get everything processed and paid out in a timely basis. So if you think you want to do this from your IRA this year, please let us know literally in the next 10 to 15 days. When you actually do this, I want to emphasize this, and this is an important takeaway, you're going to get a 1099 from the custodian. In our case, as most of you know, Fidelity and NFS hold our assets. And you're going to get this 1099, and it's going to show as a normal distribution from your IRA. So you want to make sure when you bring all your stuff into your tax preparer that you make a special note. Here's the 1099 from my IRA, but please note that we immediately distributed X amount of dollars to these various charities. You do want to check too. You probably have heard the phrase 501c3 organization, and that's a non-for-profit or charitable organization that passes IRS muster. So if there's any question in your mind about whether your charity that you want to give to passes the IRS test, just ask the charity, because we have had situations where we've made distributions and it ended up being to an organization that didn't quite pass that. If you have check writing on your IRA, you can actually do this yourself. Most people don't have check writing on their IRA, but again, you cannot make the check out to yourself. You need to make the check out and have it delivered directly to the charity. Some of you have donor advised funds, and without going into a tremendous amount of detail, they're cool tools. They're almost like charitable Roths, but you cannot make a qualified distribution from your IRA and have it go into your donor advised fund. That would not be eligible. And again, I want to stress something that's a little confusing. The new date that or age that you need to start making required distributions from your IRA is age 72. However, they did not change the age on the qualified charitable distributions. That's still 70 and a half. So again, some of you are sitting there going, well, this is a neat tool, but I'm not 70 and a half. What can I do? And the main thing that I would bring up before you write a check to a charity here at year end or even early 2022, we've had a multi-year bull market. Looking in your taxable accounts, no matter what age you are, a lot of us have a significant amount of assets, primarily stocks or perhaps stock mutual funds, with lots of appreciation from our cost basis. And just a reminder, instead of writing that check to your charitable organization, consider removing that potential tax obligation out of your estate and being able to gift that appreciated asset directly to the charity. They will take that stock or those mutual fund shares. Once it's out into their hands, you don't have any tax obligation. I'll give you a quick example. We had a client who roughly 10 years ago bought $10,000 in Microsoft. And of course, Microsoft's been a tremendous stock and it's worth about $80,000. So he is considering what to do with some of this highly appreciated Microsoft in terms of his charitable giving before you're in. So just a couple of tools to be aware of. And again, pretty exciting stuff, whether you do this before the end of the year or moving forward. So again, we got tons of data on this stuff. And if you've got some questions on how to do this prior to year end, please consult your advisor here at Infinitas, or if we can get some stuff in your hands, please reach out to us. So this is pretty exciting. And at the same time, we got to go into some of the cool opportunities that exist from an estate tax standpoint. And so I am happy to turn it over to Jim Stanziola down the hall. And Jim, if you could tell us some of the key things to be thoughtful of before year end.
Yeah, thank you, Ray. I appreciate that. And also good heads up on that distribution to a donor advised fund from a retirement account. You want to do that to a 501c3. And as Ray also pointed out, donor advised funds, however, though, are incredibly great tools for making charitable gifts. A lot of the donor advised funds will accept appreciated property. In fact, a lot of people are actually gifting cryptocurrency in a donor advised fund. So it is a very flexible vehicle for making charitable gifts, despite not being able to get that tax break on a distribution for a retirement account. So moving into the estate planning arena, as we were entering 2021 this year, we were expecting a lot of changes on the estate tax front. Bernie Sanders came out with an estate tax proposal, and we thought that there were going to be some things coming out of that severely curtailed some of the estate planning strategies, dropping the exemptions. There was talk about reducing the federal estate exemption from 11.7 million per person, which is what it currently is, all the way down to 3.5 million each. There was talk about raising the estate tax from 40 to 45% in terms of the top estate tax rate. It was proposed to eliminate step up in basis for capital gains tax purposes on appreciated property, so that when somebody dies, which is what happens right now on appreciated asset, the person who inherits that asset gets a new basis, and if it appreciated in value, they can turn around and sell that property and not pay any capital gains tax, and not have to worry about going back 30 years to figure out what mom and dad paid for that asset in terms of establishing a cost basis. There was discussion about eliminating that. In addition to that, there was discussion about eliminating grantor trust for estate planning purposes, and we'll talk about that in a little bit further detail. Well, good news. As this $1.75 trillion package worked its way from the House to the Senate, all of those proposals were dropped. There are no estate tax parts of this bill as we speak. Who knows what will happen at the 11th hour, as there's a lot of things that are going to probably be negotiated in or out of that bill. But really, there's only two things that remain on the tax front, and they're both related to income tax, and they really, at least on an individual basis, only apply to the very wealthy. So wealthy that it only affects people with incomes over 10 million. 5% surtax on people making over 10 million. What a nice problem to have. And an additional 3% surtax on people making over 25 million. There is proposed in the bill a new corporate tax rate. Now, don't panic too much on this one. This only applies to C corporations. Not S corporations or LLCs, depending on how you're structured, and moving the 21% rate to 26.5%. It was originally proposed to have a 15% minimum tax, and this has replaced that. So we'll see what happens there. So, moving forward in terms of what can you do now and even before the end of the year, and also with no estate tax proposals having made it this far, and probably will not make it into the final bill, is what we're expecting. There is a new window that's opened up, and we currently have clients that are doing things to preserve the $11.7 million per person. So if you're a couple, that protects over $23 million of asset value. In terms of not having to pay any federal estate tax. You can also gift that during your lifetime and take advantage of that as well. So you can move a lot of asset value on the other side of the tax fence for the benefit of your family. This particularly applies to family-run or closely held businesses that might potentially be in an estate tax situation. Now, keep in mind that only, even though there was no reduction in the estate tax exemption that has made it thus far into this bill, it was already scheduled to get reduced by January 1st of 2026, basically cut in half. And so that's already in the law. That's already scheduled to happen. It's referred to as a sunset provision. We'll still have an exemption, but it's going to be a lot less. So there are still opportunities to take advantage of the full exemption now, and we'll talk about some things that you can do there. Couple that with this still incredibly low interest rate environment that we're in. There are certain things that we can do coupled with grantor trust that are very effective ways to move asset value out of your estate for the benefit of your family. But before I get too complex with some of this. Let's just kind of keep it on a basic level right now. And let's just talk about the annual exclusion gift that all of us have that expires at the end of every year. That is $15,000 per person. It doesn't have to be a family member, although it often is. You have the ability to give $15,000 to whomever you want, and that expires at the end of the year. You don't need to be worried about using up any of your exemption or paying any gift tax. That is a freebie that expires at the end of the year. So what you can do is you can give $15,000 per person. If you're married and you have 2 children, you can right there gift $60,000 a year without having to worry about paying any gift tax or using any gift exemption. And if your 2 children are married, you can double that. And so you can actually give $120,000 per person or with that group by the end of the year. So there are some things that you can do there. Now, I am a big believer when you give that amount of money to people or above that threshold, put it in trust. Put it in trust for their benefit. You can even be often the trustee of that trust if you want to be. What you're doing there is you're throwing an asset protection wrapper around that money that can be available for your kids or beneficiaries, whomever you determine should benefit from that account. Going forward, they'll have the ability to get at the income and principal if they need it, but it's asset protected. So you can gift to that trust. As I said, you can even be the trustee of that trust. If it's set up as a grantor trust for income tax purposes, and folks, grantor trusts have been a tremendous estate tax reduction vehicle for many of our clients, particularly our high net worth clients who own businesses. And here's the reason why. When you make a gift or a sale to a trust, you pay no income taxes. Yes, that's right. So if you have a flock of turkeys that appreciated in value and you sell those turkeys to the trust, all of that capital gain is not taxed. And it's not taxed because it's considered by the IRS to be a sale between yourself. In other words, you're the grantor and it's set up as a grantor trust for income tax purposes. The trust pays no tax. You pay all of the tax with respect to any income on that trust. So if you put this appreciated asset into the trust and it grows in value, all of that appreciation is going to go on the other side of the tax fence and not be estate taxed. All of the income that's generated is going to be taxed to you. Oh, that doesn't sound good. I don't want to pay any tax. Well, this is a good thing. And here's the reason why it's a good thing. You're paying the income tax, which is essentially a tax-free gift to your kids or your family. And that is a tremendous estate tax reduction strategy that many of our clients have taken advantage of, which is exactly why Bernie Sanders in his estate tax proposal went after grantor trusts, because they have been so effective in that regard. The last thing I'll mention about grantor trusts in this low interest rate environment that we're in is if you do sell an asset, which you can do to a grantor trust, you only have to use the low, it's referred to as IRS applicable federal rate, which is currently incredibly low. It's only about 1.25%. So if that asset grows 20%, all of that appreciation, 18% plus, is all going to fall on the other side of the tax fence. Some of the other strategies are listed here in terms of spousal lifetime access trusts, which are often set up as grantor trusts, and is a very effective way to take advantage of both spouses using their exemption during their lifetime, preserving that $11.7 million exemption, which is probably really not going to be any higher, and still be able to get at at the assets in the trust in terms of the income principal through the other spouse. There's also grantor retained annuity trust strategies and charitable annuity trust strategies. If you're charitably inclined, and it usually is somebody who has fairly high net worth who's going to take advantage of that strategy, but those strategies are work extremely well in this low interest rate environment that we're talking about here. The last thing that I'll mention somewhat relates to what Ray was talking about in terms of charitable giving. There were originally some proposals in this $1 trillion economic package floating through the House to basically eliminate Roth conversions. You know, why more people don't take advantage of Roth IRAs or Roth 401ks, I couldn't tell you, because they're really one of the best things out there in terms of the tax advantages. But without going into all of those details, basically, you know, what you can do is you can take the IRA that you have now and convert it to a Roth IRA, and at the same time, simultaneously, make a cash gift to a public charity and take a tax deduction. The conversion of the money you took out of the traditional IRA into the Roth IRA, you're going to be paying some tax on that, but you can offset that with a deduction for your gift to charity. And what will most likely expire at the end of the year is any cash gift to charity. You can deduct up to 100% of your adjusted gross income. It's not limited to 60% of your adjusted gross income. That is a COVID carryover that we got last year, where it went from 60 to 100% of AGI, and it was rolled over into this year, and that most likely will end after the end of this year. So with that in mind, I covered a lot of things there, and I will pass it over to you, Kimberly.